Right, well, markets are mixed this morning, but they've been hanging around all-time highs. Now, after the big rally that we have seen, a lot of investors are starting to wonder about whether the rate cut story is worth watching. Already, the U.S. Federal Reserve is expected to cut interest rates as soon as this month. And after that weak jobs report for Canada last week, alongside the U.S., there are growing beliefs that we'll see more rate cutting by the BOC. Amit Joshi is a portfolio manager at Barometer Capital Management and joins us now. Thanks for being with us. So how are you thinking about the markets in the face of kind of these two stories of record highs, but also some economic uncertainty?
Hi, John. Thank you very much for having me on. I think when you look at markets, they've been very resilient here, especially given the wall of risk that we've seen throughout the year, be it tariffs or geopolitical uncertainties and heightened uncertainty on the back of that itself. North American markets at all-time highs after being down as much as 20% on the back of President Trump's Liberation Day announcement. I think we feel pretty good about the markets in terms of long-term, medium to long-term, definitely given the backdrop of our quantitative and technical work. Relative strength in our overweight sectors continues to look really good, and market breadth has been improving. So we feel pretty good about that. We are cognizant that historically September has been a weaker month for the market itself. However, in instances where we've seen a Fed rate cut in September, we've actually seen positive performance during that month. And now, as you said, kind of the outlook for rate cuts themselves in both Canada and the U.S. Market now pricing in about 2 to 3 rate cuts for the U.S. We could see some more cuts in Canada as well. And the yield curves now are kind of showing that as well when we see kind of the flattening in the near term of the yield curves themselves. But overall, we feel pretty good given that credit spreads in both investment grade and high yield continue to be very, very tight. Doesn't look like we're seeing any type of credit issues currently. And, we got some confidence from earnings season as well. It was a strong earnings season for both Canadian and U.S. companies. We posted good average earnings growth, and we saw EPS earnings estimates move higher on the back of those earnings. So we feel pretty good about markets in the medium to long term.
So I guess, the question on interest rates is always an interesting one. And at what point, people feel encouraged by some interest rate cuts on the margin versus, central banks sometime this fall maybe coming out and saying, okay, well, actually, we have to be a little bit more aggressive because of the uncertainties around the economy, especially when there's plenty of people who still think that inflation is an issue. So what's going to be the balancing act? Like, what are you going to be watching most closely?
Yeah, I think you highlighted there very accurately is inflation. That for us has been a big risk that we've been monitoring, especially as we do get some more rate cuts. You want to make sure that we don't, kind of fuel the fire when it comes to inflation itself. And within our portfolios, our fixed income side of things, we've actually avoided longer term bonds for that reason and have kept our fixed income portfolio kind of to shorter duration bonds to make sure that duration stays low. But yeah, that's something that's definitely going to be a balancing act. I do think that rate cuts themselves, as we're talking to corporate management teams, will provide a bit more certainty and help with some of the planning that they will have in the face of tariffs, a bit of an offset. So, something that we want to monitor, of course, as it comes to inflation and all the other risks that are out there, be it, tariffs or the geopolitical issues. But I think, corporations, governments, investors will be very data dependent in the face of rate cuts and inflation. So the upcoming CPI, PPI, jobs data will all be very, very important to watch.
Okay. So with all that said, I know you've been thinking about the kinds of individual stocks, equities that you feel confident in an environment like this. Any examples you can share with us this morning?
Yeah, definitely. For us, financials have screened very well over the course of the year. They continue to show leadership, and they check a lot of the boxes that, from our investment criteria that we want to see. Some of that being, good companies that are getting better. Their operating environment is improving. They're dividend growers in the face of inflation, which helps mitigate some of that inflation risk. And within financials, Canadian financials continue to screen very well from us. We got good earnings results from the Canadian banks. So Bank of Montreal is one of the names that we own in our portfolios for clients. We were very encouraged by the latest quarter that they put up. this is a stock that we avoided for much of 2024 due to some of the credit issues that they had been going through, but initiated a position earlier this year as we saw that they'd kind of come through some of those credit headwinds. And the Q3 results were really strong. They put up a 9% EPS beat. We got further guidance in terms of improvement on the credit picture, especially in that U.S. business, and a bit of a turnaround in the U.S. business itself as well, with ROEs improving about 400 basis points there. We recently had a chance to hear the CEO, Joe White, speak at the Scotia Financials Conference, and he reiterated just, some of that certainty, feeling a bit better this time of year versus early in the year when it comes to tariffs and the operating environment. So we feel, with the credit picture getting better, and if we do see some more clarity in terms of tariffs, the commercial banking unit of their U.S. business could perform well, and they over-index to that business line compared to their peers. So we feel pretty good about that position.
And going beyond banks, but staying in financials, for example, are there other areas you're looking for in terms of opportunity right now?
Yeah, definitely. Fairfax is a name that we've owned for a long time within our client portfolios. What we've liked about Fairfax itself is just the operational excellence and consistency that we've seen from their insurance business itself, and the investment in dividend income of $2 billion, providing a lot of steadiness to their quarterly numbers. So we continue to like that. It's a shareholder-friendly company. They've been allocating capital towards share buybacks and growing the dividend at about an 11% CAGR over the last 5 years. As I mentioned before, that's a theme that we value highly in terms of dividend growth over just high yield. So that's a name that we would also highlight.
Okay. Great to have your perspective, Amit. Thanks very much. Amit Joshi joining us, portfolio manager at Barometer Capital Management.